Hi, this is Dustin with Dustin's Dollars, and today I'm going to once again be talking about AITX as I am investigating AITX for myself as an investment opportunity and sharing my research with you. And today I'm going to be talking about their profit margins as far as I can understand them. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I do not own stock in AITX currently. This is part of my process for evaluating it to potentially purchase AITX. So basically, this video should be for your entertainment only because I could be wrong about everything that I say in this video, and you need to do your own research before making any investment decisions. So the big question for me with respect to AITX's profit margins, which is a big question I have for most companies that I am looking at that have an operating business, is what is the incremental cash flow per sale? And I can look at what they've done in the past, and obviously they have a bunch of, they have their gross margins, they have a bunch of expenses under operating expenses, and some of those it's hard to tell exactly what are their fixed costs, what are their variable costs. And what I'm trying to ascertain here is really what are their variable costs so that if they sell 100 units tomorrow and they say that now we're the 100 rental units, let's say, and now they are pulling in, I don't know, $100,000 a month. I'm just making numbers up here. These may not even be quite realistic, but if they're making $100,000 a month in revenue, what were their costs for that, right? And so I want to answer that question so that I can then separately model future sales and try to say, okay, if they have this many future sales, what is that going to translate into in terms of cash flow, so that I can do a discounted cash flow analysis for the company. So, what is their incremental cash flow per sale? And if you just think about it, forget about what their reported numbers are for a moment and try to brainstorm or come up with what are the potential costs here. And this is what I come up with in terms of things that could be variable costs, right? Of course, they have some fixed costs. They're going to have their manufacturing facility. I'm kind of for now assuming that their one manufacturing facility is enough for their demand in the near future. By the time they have so much demand that they need a second manufacturing facility, the company is, I mean, I haven't gone through my full exercise, but I'm guessing they're going to be quite profitable at that point and probably presumably worth more than they are at the current moment, because that would represent, I think, quite a lot of growth. But in terms of their potential variable costs, right, you're going to have your cost of parts for every new device that you sell. You're going to have to assemble it. You're going to have to deploy that device. You're going to have to increase your cloud costs, right? Your storage and your service for the back end software that is going to grow with each individual device that's deployed, because there's more data to store. And more compute. I'm not sure exactly what they do. Obviously, in terms of their software, I'm not an employee or a customer, but presumably there's some amount of back-end processing the software does in terms of the monitoring, and those costs are going to go up as they have more devices deployed. And there's also maintenance costs, right? The more devices that you have deployed, those things are going to break, and if the customer has a rental contract, they're going to expect that to be fixed, I assume. I assume that the customer doesn't pay for the maintenance when things break. And then you're eventually going to have the replacement costs. And so that is sort of the list that I'm thinking of when I'm thinking of trying to ascertain what are their variable costs. And so what do they report, right? They report their gross margins. And so why am I even talking about this, right? Why don't I just take their gross margins at face value? And that is because I want to really understand the business. I want to actually figure out how much of this is fixed versus variable costs. And this is what they report. They report revenue, they report cost of goods sold, and then you subtract those two and you get gross profit, and that is what they report in their 10Ks and their 10Qs. I find this a little lacking because they don't actually describe what is included in their cost of goods sold. And I know folks like to compare AITX and Nightscope. Nightscope actually does a pretty good job of listing out all the things that are included in their cost of services. I think is their term there, rather than cost of goods sold. But they have a good paragraph that describes what is in there. AITX in their filings, as far as I could tell, does not explicitly state what cost of goods sold represents. And that is something that I do actually look for in the filings. I like to dig in just a little bit and understand what are the accounting policies so that I can understand the business and feel confident in my evaluation of the companies. And so what I tried to do is look at that and try to understand what that really means. And if you just look at their gross margins, this is what they look like over time. They look amazing for a hardware company, right? They look like the margins you would expect to see for a software company, not for a hardware company. And you see these in the 60s and the 70s, and with the number of quarters actually above 75%. By the way, these are quarterly gross margins, and they do give some guidance in their filings in terms of the different margins that they expect for their rentals versus for their direct sales, right? They do both. They describe this in the filings where some of their devices they will actually rent out to customers, but some others they will just do a direct sale to the customer. Oh yeah, I have it right here. They're typically offered as a recurring monthly subscription, minimum 12-month subscription contract, and they are expected to earn over 75% gross margin over the life of each deployed asset when they're under subscription. They also sell units directly, right? That doesn't say directly, but they also sell units, which generally limits gross margins to the 50% range, right? And so we take this and we say, hey, well, if they do a direct sale, figure out 50% of that cost of goods sold, or 50% of the revenue is represented cost of goods sold. But if they're rental, we should expect something closer to 75%, at least on average over the life of the asset. So go on. There we go. Did I skip? No, I don't know why I didn't go forward. Okay, so the interesting thing about that is that this doesn't really seem to track with the reported numbers. And I mentioned this in my prior video, and on their revenue growth, I touched on this, I think, just a tad bit, is we see some of these quarters in the this quarter right here, the third to last quarter I have reported, in the very last quarter, where you see the percent of revenue that came from rentals was below 50%, right? In this case, it's actually below 25%. They had a massive quarter where they sold a bunch of devices directly, rather than adding them to their sort of recurring revenue devices that are rented. And you don't see the margins drop to 50% or anywhere close to it. I would, using those rough numbers, you would expect to see them come pretty close to 50% when their sales that quarter were dominated. It was something like 80% of their sales, I think, were, I guess I can do the math here, right? Above 75%, maybe 80%, something in that vicinity, were from direct sales. So why their margins didn't go to 50% here, or in any surrounding quarter, if there was some sort of a weird effect where cross quarter boundaries, I can't explain. I have no idea why that is. It doesn't make sense to me. It just doesn't seem consistent with their guidance that they do have, stating these rough target margins, especially when they word it to say that it generally limits gross margin to the 50% range. So I'm confused from that. I'll be honest. I don't understand. Those two statements don't seem to make sense. And what I actually even did is I put forth a predicted cost of goods sold model, where I said, hey, if I looked at their revenue that came from rentals and assume that 25% of that translated into cost of goods sold, meaning a 75% margin, and if I looked at their direct sales for the quarter and assumed that 50% of that turned into cost of goods sold because they have 50% margin, what would I have predicted for the cost of goods sold, which is the blue line here, and then what were the actual cost of goods sold in that quarter, which is the red line. And you can see that it did not do that great of a job. And it's kind of hard to see how poor of a job it did in many of these quarters, because the numbers get much larger in some of these later quarters. So you can't quite tell that the distance here is quite significant. I should also note the lines, the red and the blue lines, correspond to the left axis here, and the yellow bars correspond to the right axis. And the yellow bars are showing in each quarter what was the percent error that the prediction had. If we predicted them, predicted the cost of goods sold using those numbers, the 25% costs for the rentals and 50% costs for direct sales. And you can see that routinely this was off by more than 50%. And in fact, as I mentioned, that one quarter where they had a lot of direct sales, it was off by over 100%, because it predicted cost of goods sold that were well above what the actual reported numbers were. So that's interesting to me. And it's not even always an over under prediction, right? It actually does go both ways, but it does tend to be over predictive by quite a lot more than when it under predicts the cost of goods sold. So that is, I don't really know what to take of that. Again, just more proof or more evidence, let me say, not proof, that that guidance just doesn't seem to match with the reality and the reported numbers. This is also just a graph kind of showing again the actual breakdown of how I built up that number of the predicted cost of goods sold. The blue and the red, they stack in this particular chart. So the red the areas are showing you those. The red line at the very top of that stack is showing you what the total predicted cost of goods sold would have been underneath that model. So feel free to pause it here if you want to take a look, but I'm going to move on since I've kind of talked it through. And so that doesn't really leave me with a very good understanding of what their the question that I was trying to answer originally, which is what is their incremental free cash flow or incremental cash flow per each sale that they make. So I looked at some other stuff that we have in the filings, right? What else do we know? We know their total amount of revenue earning devices. We know their accumulated depreciation that they have in those devices, and we know their inventory, right? They call it device parts inventory. And so I have a couple quotes that I've copy pasted here just to call out a couple important items and accounting policies. For revenue earning devices, they are stated at cost. And it says that they depreciate these over an estimated useful life of 48 months, right? Straight line basis. And when they say they're stated at cost, I think the other interesting thing is that they have their inventory, right? And this inventory is also stated, let's say they say at the lower of cost or net realizable value. Let's, for now, assume that they are stated just at cost. Because it's either at cost or an even lower value. But let's just assume for now that they're stated at cost. And they also explain here that depending on how they end up using that inventory, they will transfer the parts to the corresponding asset or an expense if they use it for R&D, right? If they're actually using it in R&D when they're prototyping devices, whatever. Today we are not going to discuss any of that. We're going to discuss when they do actually transfer those parts inventory into revenue earning devices, because they have reported that in most quarters for the past 2 years or so, maybe almost 3 years now. And so the interesting thing is they also report the total amount of revenue earning devices that they have on their balance sheet. They report those as an asset. And this chart is interesting. And I looked at this where if you look over time, this chart is showing you starting from the end of February 2019. If I take that as a 0 point and I look from that point forward, what is a total increase in revenue earning devices that they have added to their balance sheet as an asset, ignoring depreciation, right? So just the total value of those. And then what is in total also, what is the addition of every quarter, the cumulative inventory transfers to revenue earning devices, right? So how much of that inventory that again was stated at cost did they take from that asset and transfer into revenue earning devices? And you can see that this matches very closely, in my opinion. Right, it's not exactly the same, and there was this gap somewhere in late 2020. I'm not sure what exactly happened here, and I kind of assume that this is a bit of sort of when things move around, right, there's some effects at the beginning of a quarter, end of a quarter, depending on exactly when some transactions take place. That is my best explanation for why there are this gap here and these smaller gaps back here, which were probably similar on a percentage basis at the time. But more or less it tracks, and this roughly explains the assets, right, where it seems like they are actually stating the revenue earning devices at the cost of the inventory that it took to put the devices together. So the interesting thing here, if we also then track that, how much inventory did the company transfer to revenue earning devices each quarter versus what were the cost of goods sold in each quarter. And you can see here that these don't really seem to track at all. And you have a number of quarters where they transferred more inventory to revenue earning devices than they actually had cost of goods sold for the quarter. And the more interesting thing to me is if we do this cumulatively, right? We look at from the start point of this analysis, which was the end of February 2019, how much inventory have they transferred to revenue earning devices, meaning how much have they actually manufactured in devices, and just in terms of parts cost, that's all we're looking at here. That's all inventory tracks. And then cumulatively, what were their cost of goods sold? If I just add that up quarter over quarter since the end of February 2019, you can see that they've actually transferred more. They spent more in parts that they then transferred into revenue earning devices in inventory than they actually have on their total cost of goods sold. So that seems really strange to me, because I would expect the cost of goods sold to include their parts costs, and it doesn't look like it does. So, and in fact, it looks like they've actually spent almost, roughly, I'm ballparking here, like twice as much, right? Because this is not a stacked area chart. I don't know. I didn't actually intend for these to be areas. It was my mistake. They should have just been lines here. There's no semantics attached with that, but you can see that they've transferred about, just again, ballparking, about double the parts cost into revenue earning devices as they actually have noted in terms of cost of goods sold over this time period, which is pretty interesting. And I think I think this time period is representative of the company in its current form. It looks like before this point, the numbers were so small, they really just don't matter that much. And it seemed like there was some change up at the company. So that's a bit why I picked this time period. This is also when the reporting kind of got more standardized and matches what they still do today. So in terms of actual numbers, I summed up their total cost of goods sold over that period. And I believe it, again, let me also call out, I could have made a mistake transcribing numbers here. This was me manually getting all the numbers from the filing, so I could have gotten a number wrong somewhere. But assuming that I didn't, because I did try to check my numbers, they had $410,000 of total cost of goods sold, but they actually transferred $730,000 roughly of inventory to revenue earning devices, and they actually noted an increase of $717,500 in terms of the actual increase in revenue earning devices, excluding depreciation. And the other thing is, this doesn't even mention direct sales, right? Because this is an assumption that I'm making because it's not stated explicitly in the findings, but I'm pretty sure that those revenue earning devices only track the devices that are represented by rentals, right? When they make direct sales, I don't think that is included in terms of, I don't think that would show up as an inventory transfer to revenue earning devices, although I'm not sure. Maybe it does, but regardless, and my basis for that is this graph back here, where we see that the amount that they transferred into revenue earning devices tracked pretty well with their actual how much they track as an asset for revenue earning devices. So that was really interesting. And when I say interesting, confusing to me is really what I mean. So going back to our list of potential costs, we kind of have an idea for parts. And we kind of have an idea for replacement in the sense that they say, hey, we believe that these, or at least for accounting purposes, we are tracking these devices over a useful lifetime of 48 months. What we don't have is any real guidance on the rest of these pieces here. And I'm taking what you might take as, you might say that I'm totally wrong. Feel free to roast me in the comments, tell me how wrong I am. And especially if a better resource that explained this, I would love to see it. And, I would be happily make an updated video with a newer, more accurate answer to this question, if someone can provide that to me. But I am generally now assuming that the cost of goods sold doesn't seem to state the parts, because they just don't, the numbers don't add up as far as I'm looking at it. So I think that I'm interpreting cost of goods sold to include some representative sample of the rest of these: the assembly, deployment, cloud costs, and maintenance. And So what I am doing for my own modeling, again, feel free to do whatever you want. I am estimating their margins here. This is actually, I think, an upper bound on their margins, but maybe I'm wrong. Again, could be totally wrong on this because their filings just don't really spell it out very well. So this is me trying to fill in the gaps as best that I can. I am estimating the margins using the sum of their cost of goods sold and their depreciation that they have in revenue earning devices. And I am what I'm actually doing here is I'm estimating the portion of their cost of goods sold that applied to only their rental revenue, right? Because right now they don't split that out, as far as I could tell, how much of the cost of goods sold came from the rentals versus the direct sales. And so what I just did here is I kind of assumed that we would have 2x the cost of goods sold for direct sales versus revenue, because that comes from that prior guidance in terms of what their margins are that they expect for both of those. And so if I prorate the cost of goods sold each quarter using sort of that logic, and then I add that to the depreciation that they do explicitly call out for the revenue earning devices, I get a graph that looks like this. And so the way you should read this is the lines correspond to the left axis, the columns, the bars correspond to the right axis. The lines, the blue line and the red line do stack, and the blue line is my estimated portion of the cost of goods sold that is attributable to rentals. And the red area there that again stacks on top of the blue is how much accumulated depreciation increased in that particular quarter. And so when I add those together, and that's the actual red line that's at the top of both of those areas, and you can see how that changes each quarter. And then I compare that against the revenue, which is not shown on the graph here, but I computed what if this red line represented their actual what I am terming their costs here, and compare that against their rental revenue. These are the margins that you get, are the green bars, and that corresponds to the right axis. And you can see that the numbers do spike, and they are a little wonky, especially in this particular quarter, right, the third bar from the right. And things got all weird again. That's the quarter where they had a whole bunch of direct sales, and the numbers just seem weird. If I throw that one out as an outlier, because I don't think that it's representative of the future, and I look at these other 3 of the 4 last quarters, I get a rough margin in the 46-47% range. And, that is the conclusion here, at least my conclusion that I am using when I'm looking at their potential profits going forward. And so this is what I would usually think of as their kind of gross profits. And again, this is sort of incremental on top of what their prior margins have been, their prior costs, right? This is if I think they make a new sale, because again, they're going to have all their fixed costs that are already represented in some of their existing filings. But I think if they make a new sale, this is the number that I am going to use in my models to try to estimate how much of that money is going to actually go back to the company that can potentially, offset some of the operating expenses and eventually become, free cash flow for the company. So that is my full analysis. Feel free to let me know in the comments what you think if you have better information, you think I got something wrong, please let me know. I would love to have a more accurate answer here, and I would appreciate it personally. But thank you for watching.